Hello, I'm Austin Schaul, Head of Research with Avantax. Today we will provide a market update for October. We'll start with the recap of returns for September and then shift to an update on the Federal Reserve, the economic backdrop, valuations, and our outlook going forward. The month of September has historically been a challenging one for investors. However, stocks around the globe were able to avoid a September slump, and all major indices finished the month in positive territory. The S&P 500 tacked on nearly 3.7% in total return during the month, while the Russell 2000 finished the month higher by 3.1%. Overseas, emerging markets led the way, rallying more than 7% in total return. Developed markets lagged their emerging markets counterparts, though the MSCI EAFE index still managed positive returns of nearly 2%. Through the first 3 quarters of 2025, emerging markets are leading the way, higher by more than 28%. Stocks in China have rallied more than 40% so far this year and account for roughly 1/3 of the emerging markets index. International developed markets have had a strong year as well and are higher by nearly 26% so far. Here in the U.S., the S&P 500 is on pace for another very strong year as well, with the large cap index higher by nearly 15%. In small caps, the Russell 2000 has rallied more than 10% after a shaky start to the year. September brought a breath of fresh air to bond investors. With interest rates easing, both taxable and municipal bonds saw a meaningful boost. Taxable bonds, as measured by the Bloomberg U.S. Aggregate Index, gained 1.1% in September. Municipal bonds played catch-up, rallying more than 2.3% after a sluggish start to the year. All told, the taxable bond index is higher by more than 6% on the year, while the municipal bond index is higher by 2.6% in total return through September. For diversified investors, this rebound reinforces the value of staying the course. Bonds are doing their job, providing income and stability amid market uncertainty. The recent rally in bond markets can be largely attributed to interest rate policy. The markets have spent the past couple of months recalibrating their expectations for future rate cuts from the Fed, which put downward pressure on the yield curve in September. In the Federal Reserve's most recent policy-setting meeting on September 17th, the central bank voted to enact a quarter-point rate cut, which marked the first interest rate cut since December of 2024. More importantly, comments from Fed Chair Jerome Powell indicated that additional rate cuts are likely on the horizon at the 2 remaining policy-setting meetings this year, which will take place on October 29th and December 10th. This chart shows what we refer to as the Fed dot plot, with each dot representing the opinion of where interest rates are likely to finish each of the next 3 years. As you can see, there are 9 FOMC members who believe that we could see 2 additional quarter-point rate cuts this year, for a total of 75 basis points. With the Fed's benchmark interest rate currently around 4.1%, we could see this move as low as 3.6% by year end. As we enter the final quarter of 2025, the economic landscape is defined by a mix of cautious optimism and structural uncertainty. At a high level, the U.S. economy appears to be on solid ground. While real GDP growth for the first quarter was negative, we saw a rebound in the second quarter of positive 3.8%, and the Atlanta Fed's third quarter GDP Now forecast is for 3.9% growth. The biggest concern right now is around the labor market. While the unemployment rate is relatively low at 4.3%, it's the highest since 2021, and the pace of job creation has slowed significantly. The good news is that companies aren't laying off a lot of workers either. These slowing labor market conditions align with our broader expectations for moderating economic growth. In the months ahead, we will be keeping a close eye on the Supreme Court hearing on tariffs in November, which may cause uncertainty in the near term as investors digest the potential ramifications, both good and bad. After that initial period of volatility, we think this certainty could act as a tailwind, regardless of the court's ruling, as markets tend to respond positively to reduced uncertainty. Bringing it all together, equity markets have rebounded sharply since the April lows, with valuations now elevated and earnings expectations rising. As this final chart shows, the S&P 500 trades at a valuation multiple well above its historical average. With earnings optimism rising again, there will be a higher hurdle to exceed expectations. This is particularly true for the high-performing AI-related mega-cap tech stocks. However, increased volatility and shifting sector leadership are likely as markets adjust to new macro conditions. We continue to see opportunities both domestically and abroad, particularly in pockets where valuations are much lower than U.S. large caps. Going forward, we think diversification remains critical, particularly as companies that thrived in the previous cycle may struggle to meet heightened expectations. So that's what we have for this month. Thank you for watching and have a great day.